Now we are going to get to the stock market. Our call early in January, beginning of January last year, was not great because the market volatility was just immense with that big break. We thought there would be a decline of some 12%, and that it would then rally back and have a good, strong fourth quarter. With only maybe a small loss for the year. Well, we know what happened. We went into a total collapse because of COVID-19, and then a massive rally back to the upside as the Fed and central banks around the world poured liquidity into the markets, and the stay-at-home, work-at-home tech stocks that were supportive of that technology exploded to the upside with massive gains. Let's take a look at that as we now switch over from this bond market chart to SPX. So here are the cycle patterns here in SPX and our projections for this coming year. So all along we've been talking about 2021 being a rough year for the stock market. We're definitely unique in that is that most analysts think it's going to be another good year for the stock market. There are a few out there that are talking about the likelihood of some decline. We never want to be aligned with the doom and gloomers. We are totally agnostic. I have no problem being bullish. As you saw when we called the markets moving to the upside in the gold market, specifically in the oil market, we caught all during the last year as the markets were saying they were going up. The short-term indicators, our momentum indicators for the stock market, were great all year long. They never turned down. I mean, essentially, if you followed momentum, you were a huge winner. Here you see the cycle analysis going back to 2003, and you could see these large harmonic families. In this case, the harmonics, again, are close to the principle of nominality at 76 for the dominant, 38 for the intermediate, and 89 for the 19 for the minor. And all of these cycles really very clear, well, except for where they got swamped, like right over here, because there was barely any decline to see. So here you see we had this big decline when COVID hit, 35% to the downside. This was the mini bear that happened right over here in 2018, a brief one, 24% to the downside. So how did we do for the year? Well, S&P 500 up 15.6%, Dow Jones up only 6.2%. There were some stocks that struggled in there, specifically like Boeing. The NASDAQ, which supported all the stay-at-home activity, those stocks exploding to the upside for a 46% gain. And the Russell coming on towards the end of the year for 19%, as the stocks in there that benefit from all of the recovery that is expected really began to move to the upside. So now let's talk about our projections for the coming year for the stock market. We believe that there will be a peak in January to February, that the rally we're in now will be able to continue briefly. It is likely to get a test based on the intermediate patterns after that. So we think that there'll be a peak and a large decline into February, and then a test on the upside in the April to May period. It may be slightly short of the highs, it may be slightly higher. This is where we don't agree with almost everybody out there. We expect the range to be 3860 at the high. Now we're looking at this fib extension right up over here at 3860. It extends the megaphone that you see up by just a little bit. That then after that, it will then begin to correct with a correction into that February, early March period, another rally, a false rally, and then a big decline taking hold in here, and an actual bear market occurring. We believe 2021 will have a bear market. It will end the year closer to the lows. There are three nested cycles coming in right in here, which are likely to affect it in a very negative way. You can see what happened here after the 2007 peak. And those three cycles coming down, the three cycles coming down here, only a 16% decline in the 2016 mini bear. And then we're dealing with, and if you watch our last big picture analysis, I showed you the remarkable 7-year cycle, which goes down into 2023. So there are immense downside pressures on this market when we look at that. I'm going to talk a little bit more about that and then come back to the chart. This is a very important chart on stocks versus commodities. We give credit to Katusha Research for bringing this out. And you can see in here the beauty of this as you look at the disparities that are occurring or that have occurred in here. So this is when equities are expensive and commodities are cheap. And you can see that when that happens, the commodity market right over here, extremely cheap. What's going on right now, it was very, very cheap right over here in the relative to stocks in the tech bubble. You can see that right over there. So stocks exploded, and then this compares commodities to stocks, and commodities to stocks were basically on their lows right over here. And then when the stock market crashed and techs lost, some 80-something% of their value, that relationship began to change. In the financial crisis right over here, when stocks collapsed, then of course commodities were high relative to stocks. And look where we are right now. So if you want to make a case for the stock market going down and the commodity market doing better, this clearly screams at that right here. I mean, this says that stocks relative to commodity markets are just at a record disparity that we're seeing. So that makes stocks extremely expensive relative to commodities when you look at that. Let's take a look at another chart here. And this, thanks to advisor perspectives, that brings just amazing work. And I really recommend you go look at their site, Advisor Perspectives. This is a look at margin debt versus the S&P 500. So the Fed, which is in their brilliance, encouraged people to take on massive debt and made people believe that there is nowhere to invest other than the stock market. And if you don't invest in stocks, you're simply going to miss all of the moves, and force people to just be like the Robin Hood traders, investors, open up accounts, millions of them, buy stocks at ridiculous levels, and do it on massive record margin, as you can see right over here. The S&P 500 up to record levels here. The amount of margin, the margin debt, just absolutely at a record. Of course, these are inverse, so they flip the charts. So this is also a reflection of credit balances also. So what they did was they made these inverse to each other, so you could see record levels here of margin, record levels on the stock market, and when that begins to reverse, it does peel off quite quickly. November margin debt surged a record levels 9.5%. So you could see the money pouring into the stock market. Everybody wants to get in there before the market goes to that 42 to 4,600, and the amount of cash in mutual fund hands is at a very, very low levels. I think now under 4%. So the levels that we're seeing are just incredibly crazy. Take a look at one more chart in here I want you to see, and that is this Wilshire 500 to the GDP. I've showed this before. Thanks to long-term trends for this chart. This is a dynamic chart that they put up on their site. And with cash manager reserves at 4% or less, this is the Buffett indicator, which looks at the market to GDP. It's at 183%. You can see over here at the dot-bomb period right there, where markets collapsed, it was nowhere near that level. 2007 financial crisis, even lower. Look where we are now. It's going to take a level of economic growth that is not possible to have this make any sense at all. That's what they're counting on. They believe that printing money equals growth. Print money equals growth. That's what they believe. That's their the core of how our leaders in this country running the Fed, that's how they operate. They'll do anything to keep what looks like deflation from happening, And what they've done instead is caused inflation in asset levels to this, which is a pending crisis in the stock market, with all of these young novice traders getting hooked into the market right now, and people afraid to sell. And believe me, they're not going to sell until they have to sell, most people. And I'm warning right now that if you're not going to sell, when will you sell? If you won't sell now, when will you sell? It makes no sense to me to not be lightening up in an immense way here. It doesn't matter if you miss more on the upside. Preservation of capital at these levels is what makes the absolute most sense. So let's get back to that chart that we're looking at right over here. Again, what we see in here is the likelihood of a peak in the stock market coming early in the year. Probably going to get a decline of some significance into sometime into the late February, March period. We have showed that on our weekly charts, which you can see which will show in Future Speak coming up next week, and then another potential uptick in there to test the high, maybe not, and then some very, very weak period over here as all of these cycles begin to move down. Our most optimistic call that we can make would be a decline over here to this level about 2,900, which would be a 25% bear market at the 61.8% retracement level. That would be what we think would be kind of a best call, with a potential to get down over here around 2,700. Also, some people are looking at this and saying this guy's nuts. Of course, if you look at markets going back in history like I do, these bear markets come and come and come. Excuse me for this cough. This has been a very, very long show. So again, we think 2021 will have a bear market in it, and that it's going to end closer to its lows. Those three nesting cycles are really what we're looking at, and the downside target is likely 2,700, though it could get down to 2,900 and stop. Where that support is, that would be a 25% drop. 25% drop would be a substandard bear market, a average lasting 14 months, and over 30%, like about 33%. And we think it would be just a normal bear market to get a 30% loss here, getting down to that 2,700 level.